Hey everyone, and welcome back to the channel. Today, we're diving into a super fascinating topic that sits right at the intersection of psychology and money: behavioral finance. Have you ever wondered why we sometimes make financial decisions that, in hindsight, seem a little irrational? Like panic selling during a market dip or holding onto a losing stock for way too long, hoping it'll bounce back? Well, you're not alone, and there's a science behind it. So, what exactly is behavioral finance? In simple terms, it's the study of how our psychological biases, our mental shortcuts, and emotional blind spots affect our financial decisions, and, on a larger scale, the financial markets themselves. The traditional view of economics often assumes we are all perfectly rational beings, always making logical choices to maximize our wealth. But let's be real, we're human. We get scared, we get greedy, and we get overly optimistic. These feelings play a huge role in how we manage our money. Let's break down a few of the most common biases. First up, we have loss aversion. This is a big one. Psychologically, the pain of losing $100 feels much more intense than the pleasure of gaining $100. This fear can lead us to make overly conservative investment choices, missing out on potential growth because we're too afraid of the downside. It also explains why we might hold on to a losing investment, because selling it would mean making that loss real, and that hurts. Next, let's talk about herd mentality. Humans are social creatures. We often look to others for cues on how to behave, especially in uncertain situations. In the financial world, this means we might buy a stock simply because everyone else is buying it. Think of the hype around certain meme stocks. We see the price soaring and get a major case of FOMO, or fear of missing out. The danger here is that the herd can be wrong, and you might be jumping on the bandwagon just as it's about to go off a cliff. Following the crowd isn't always a sound investment strategy. Another powerful bias is overconfidence. Many of us believe we're smarter or have better information than the average investor. This can lead us to trade too frequently, thinking we can time the market perfectly. We might pick individual stocks convinced we've found the next big thing. While confidence is great, overconfidence in investing can be costly. The reality is that consistently outsmarting the entire market is incredibly difficult, and all that extra trading just racks up transaction fees. So, how can we use this knowledge to become better investors? The first step is self-awareness. Just by understanding that these biases exist, you're already ahead of the game. When you're about to make a big financial decision, take a moment to pause and ask yourself, am I making this choice based on logic and my long-term plan, or am I being swayed by fear, greed, or the hype of the crowd? A great way to combat these biases is to create a solid financial plan and stick to it. This means setting clear goals, understanding your risk tolerance, and creating a diversified portfolio. A well-thought-out plan acts as your anchor during emotional storms. When the market gets volatile, instead of reacting emotionally, you can refer back to your plan. It helps you stay the course and avoid making impulsive decisions you'll later regret. Another practical tip is to automate your investments. Setting up automatic contributions to your retirement account or a brokerage account is a powerful tool. It takes the emotion out of the equation. The money gets invested regularly, whether the market is up or down, a strategy known as dollar-cost averaging. This disciplined approach prevents you from trying to time the market and keeps your biases in check. Understanding behavioral finance isn't about eliminating emotions. That's impossible. It's about recognizing them and building systems to prevent them from derailing your financial future. It's about being a smarter, more mindful investor. By acknowledging our human nature, we can make more rational and ultimately more successful financial choices. I hope this gave you a clear and simple introduction to the world of behavioral finance. It's a game changer once you start applying these concepts. If you found this helpful, be sure to hit that like button and subscribe for more content on mastering your money. Thanks for watching, and I'll see you in the next video.